With the 2022-23 tax year coming to a close on 5th of April 2023, time is rapidly running out to take advantage of the opportunities out there to minimise our personal tax liabilities. In this video, we're going to discuss some essential tax planning strategies you should be considering before the end of the tax year. This video is being released in February 2023 and specifically relates to the 2022-23 tax year. If you're watching this video after this, please bear in mind that what we cover may not be applicable to future years. The purpose of this video is to inform and hopefully entertain. It is not a substitute for obtaining proper advice, as everyone's situation is different. If you're interested in any of the opportunities below, fill in the contact form on our website. There's a link in the description below, and we'll be happy to discuss whether they are right for your particular circumstances. Pension contributions. Pension contributions are an efficient way to save for retirement, since they allow you to save some of your income before it gets taxed instead of after, such as if you save money in a regular savings account. When it comes to taking your pension later in life, based on current rules, you'll be able to take 25% of the fund you have accumulated completely tax-free. Planning tip: maximise your pension contributions to increase your tax relief as part of your retirement strategy. If you're an employee, you may already be in a pension scheme and can request from your employer to increase your employee contribution in order to make best use of the tax relief. If you're not an employee or are not eligible to be in an employer pension scheme, you can set up a private pension scheme and make contributions that way. Higher rate taxpayers will often need to complete a tax return to ensure they're receiving all the tax relief they are due on their pension contributions. Planning tip: if you're a higher rate taxpayer, make sure you're claiming any extra tax relief you're entitled to. Tax relief on personal pensions is limited. You can only receive the relief on contributions up to 100% of your annual earnings. Earnings are most commonly employment income, such as salary, or income from self-employment or a partnership, but it doesn't include investment and savings income, such as dividends or rental income. If you're a non-taxpayer, or you have very low earnings, you can still pay up to £2,880 each year into a pension fund, which will automatically be grossed up to £3,600, even though you did not pay any tax on the income. There are limits on how much you can contribute each year and receive full tax relief, as well as limits on the value of the fund at retirement. Exceeding either limit can result in a further tax charge. Planning tip: if you have annual income of £200,000 or more, or the value of your fund has exceeded or is close to £1 million, you should seek advice from a pensions expert before making contributions in order to avoid an unwanted tax charge. Individual savings accounts, or ISAs. ISAs can be easily forgotten about, since we're coming from a period of very low interest rates and tax-free allowances for savings income. However, with interest rates on the rise, it is more important than ever to make sure that your savings income isn't being taxed and you're obtaining maximum benefit for some of the more specialised ISA types. There are two main flavours of ISA: cash ISAs, which retain your investment in cash and earn interest, and stocks and shares ISAs, which allow you to invest your capital in the markets. The income from savings held in ISA accounts is tax-free. You can save a maximum of £20,000 per year in an ISA. Planning tip: make sure to use as much of your ISA allowance as possible each year, as it's a use it or lose it situation. Now, let's look at some of the specialist ISAs that you can benefit from. Lifetime ISAs. A lifetime ISA is intended to help you buy your first home or save for later in life. The annual limit for a lifetime ISA is £4,000, and this is part of your £20,000 total limit. But for every £1 you contribute to a lifetime ISA, the government will add a 25p bonus. So if you make the maximum £4,000 contribution, the government will add a bonus of a further £1,000. Unfortunately, lifetime ISAs are only available if you are between the ages of 18 and 40. To be young again. Planning tip. If you are between 18 and 40, maximize the amount you contribute to a lifetime ISA in order to benefit from the free 25% bonus to the amount you save. You can withdraw from your lifetime ISA if you are buying your first home, aged 60 or over, or you become terminally ill with less than 12 months to live. Junior ISAs. Junior ISAs are for children under the age of 18 living in the UK and can be opened by parents or guardians, but the money does belong to the child. The child takes control of the account at age 16 and can withdraw money from the age of 18. The savings limit for a junior ISA is £9,000, which can be contributed by a parent or guardian. The extra tax benefit of a junior ISA over a regular ISA or savings account is that normally when a parent contributes to savings for a child, the income on those savings is treated as the income of the parent rather than the income of the child. A junior ISA allows parents to build up a fund for the benefit of their child in a tax-free wrapper. Regular ISAs cannot be held by children. As the junior ISA belongs to the child, the £9,000 threshold does not form part of the regular £20,000 annual ISA savings limit, and so allows a parent to save more if they're able, so long as they're happy that the money does belong to the child. Planning tip. If you want to save for your child to give them access to a lump sum when they reach 18, contributing to a junior ISA is a tax-efficient method that won't impact on your own ISA allowance. Before we move on to our final few tips, can I ask you to give the video a like? It really helps us to know that this is the type of content that you want to see, as well as help us grow the channel and reach out to more people like you that can benefit from our videos. Whilst you're there, if you're not already subscribed to our channel, please do click the subscribe button to help the channel grow. Dividends. Business owners can declare dividends from their company profits. Tax planning should take place during the year to ensure that profits are extracted by way of salary and dividends in the most tax-efficient manner. Planning tip. If profits allow, business owners should ensure they receive at least £2,000 in dividends from their company before the end of the tax year to take advantage of the tax-free dividend allowance. This allowance is being reduced to £1,000 from April 2023 and £500 from April 2024. Capital gains tax allowance. If you're thinking of selling an asset that will be liable to capital gains tax, such as a rental property, shares, or even your business, it may be beneficial to try to achieve this before the 6th of April. The current capital gains tax allowance is £12,300, meaning that the first £12,300 of profits you make on a sale in this tax year will be tax-free. From the 6th of April 2023, this reduces to only £6,000. Planning tip. If you haven't already used your capital gains tax allowance this year, and it's possible for you to sell an asset before 6th of April 2023, then doing so now will maximise the tax relief you receive from your capital gains tax allowance. Before we move on to our final tip, have you thought about anyone else whilst watching this video? Family members, friends, colleagues, or business contacts who might benefit from these planning tips? If so, why not take a moment to share this video with them? You can do this really easily by clicking the share button below this video. Gifts for inheritance tax. Normally, any gifts that you make in the 7 years before your death may still be subject to inheritance tax, IHT, when you die. But it is possible to give certain gifts which are exempt from IHT. Planning tip. You can give away £3,000 worth of gifts each year without them being included in the value of your estate when you die, even if they were made in the 7 years before your death. Any unused exemption can be carried forward to the next tax year, but only for 1 year. The £3,000 can be given to one person or split between several people. Planning tip. You can also give as many gifts of up to £250 per person per tax year as you like, as long as you haven't used another allowance, such as the £3,000 gift allowance, on the same person. Summary. Although we're a month and a half away from the end of the tax year, there's still time for you to take action and maximise your tax reliefs. I hope that this video has been useful to you and you've found something that you can do to reduce your tax this year. Even if you're able to take just one action, do just one thing, that's one thing that's putting more money in your pocket. And sometimes just one thing is all it takes. See you on the next one.